The economy is stronger than it's ever been, and you're going into retirement. And if you're going into retirement in a time like this, you got to think, wow, I'm so blessed. There's so much information. There's so much technology. There's so many good advisory firms that are out there. And look, whether you work with us or not, the thing that I want you to know is you've got to have confidence going into retirement. And if you don't feel that in your heart and in your gut, you need to reach out to someone and you need to say, hey, what can you guys do for me? I just want to have a conversation. Most firms don't even charge for a consultation. Like, talk to someone about your situation. It's important. I think it's important. I think it'll lead to you having a better quality of life in retirement, and that's what you deserve. Welcome to the show. This is the Build Big, Live Bigger podcast. This is where you get real clarity about retirement so you can build a plan that blesses your life instead of becoming it. We'll share what you need to hear to replace worry with confidence, protect what you've built, and actually live your dreams, not your fears in retirement. Let's dive in. All right, welcome to episode 29 of the Build Big, Live Bigger podcast. My name's Jonathan Burgess. I'm going to be solo today. So I'm your host. I'm the founder and owner of Big Money Retirement Solutions here in the upstate of South Carolina. And I guess I should say all of South Carolina now, since we have a Charleston location. But wanted to talk to you today about war, oil, and your retirement. So, Iran's been in the news for a while now. Now you've got oil prices that are going nuts, and you may be wondering, Jonathan, how's this going to impact my retirement? Well, on your drive today, your walk, or whether I'm just catching you in the kitchen, we're going to talk through all of that. And so I wanted to hit on, what is the conflict really doing? So the big question is the conflict in Iran going to crash your retirement? And the ultimate answer to that is I have no idea. And here's the thing, this is why you need a good plan, but I want to talk about all of the underlying issues and why it could be a problem, what you can do to create solutions to those problems before they occur, and what are maybe some of the things that you should be thinking about as it pertains to your retirement and the subject. So the Strait of Hormuz contains about 20% of the global oil supply in the world, which is where Iran is. And anytime there is difficulty in getting into an area, obviously there's going to be a problem getting oil out of that area. And so the world's oil supply is constrained. And when the oil supply is constrained, oil controls a lot of things that we don't even think about. Number one, it controls gas prices. Okay, so let's start there. And I always love to explain things as if I was going to explain them to my mother. So that's what I'm going to do. This may seem like a very basic explanation to what's going on, but hey, those are the ones that I love. So the oil supply is constrained, and when it is, the price of oil goes up. Anytime something is harder to obtain, typically the price is going to rise. When supply decreases, demand increases, and so price goes up. So that's why you're driving around right now, and at least in South Carolina, the average cost per gallon of gas at the beginning of the year was about $2.60, and today it's about $3.55 as of March 20th. So oil prices are up, or gas prices are up by about 95 cents a gallon. When the cost of gas goes up, it impacts everything from making sure that the grapes in your produce section at your local grocery store get delivered, and they may increase by a couple cents, all the way up to the CEO of Walmart going out on his Gulfstream jet. If it costs $120,000 to fill up his very nice $75 million plane before, now it costs $160,000. So this creates a large array of issues ranging from the everyday American going to pick up their groceries to the executive flying on their airplane to go and visit, the other executives within that corporation. Now, a lot of these corporations are companies that are publicly listed on the stock market. And when you are spending more money on energy costs, for instance, let's go back to the Walmart example, everything from the CEO going on the Gulfstream to the trucks driving around delivering the food, they are having to pay higher transportation costs. So then what goes down? It's earnings per share, because your net profit is being squeezed because of increased energy costs. So what does that do? Earnings per share generally going down will result in a lower cost per share, or a lower price of the stock. So the stock market starts to pull back a little bit too. So you may be thinking, well, if these things, is there anything else that could negatively happen? Yes. And it is inflation. because inflation and interest rates, really the underlying risk to all of this is inflation. But when inflation is rampant and inflation is very high, what does the Federal Reserve, which if you don't know what they are, they're the central bank of the United States, they control interest rates. When inflation is just shooting through the roof, what they're going to do is try to raise interest rates to account for all the things that are happening, make it harder to borrow money to try to slow demand, to try to get the economy in check and try to slow inflation. You have all these factors happening at the same time. Interest rates are rising, borrowing costs are harder. Now companies can't expand, and it's a virtuous cycle that happens when the market expands and then contracts. And we're starting to feel it for the first time. And this is why I talk so much about having the right financial plan, because what's happening in the world right now is all noise. It's fear. It is very worrisome to someone who's solely focused on their income. But when you have a plan, the plan is the confidence and silent. So what's it called whenever you have interest rates that are raising because of inflation and you have a market that is slowing in growth? It's actually called stagflation. So you may have heard the term stagflation. You're like, Jonathan, what the heck does that mean? I'll explain it to you. Imagine you're on the highway and you're hitting the gas pedal to go faster, and at the same time, you're hitting the brakes. So when inflation is rising, that's the foot on the gas. And when your spending power is going down, that's your foot on the brakes. So what's happening is the markets aren't growing as fast as they should. And so the stock market isn't growing like it should, but the cost of goods and services are still going up. You're basically sitting in the same place, expending more energy. And so that can be very detrimental to a retiree's portfolio because they need that steady growth rate to keep up with the distributions that they're taking out every year. And I found a statistic that I wanted to bring up. So every 10% increase in oil prices, WTI, if you look it up, that's the price of crude oil. With every 10% increase in oil, there's roughly a 0.3 percentage increase in inflation. So every 10% increase in the price of oil is roughly a 0.3% increase in inflation. And I ran the numbers month to date. The price of oil or crude oil is up by 47.37%. Year to date, it's up by 71%. That is a staggering figure. That means that we are nearly 2% in on inflation being way too high. So we're actually a little bit over 2% year to date, and it is currently March 20th, the day that I'm recording this. So, so I've talked a lot about the problems and, what the war could entail. And I think there's a few things here, right, with knowing what the markets have done in the past. When the Iraq war happened, the markets actually rose. So, we never really know what's going to happen in a conflict, right, like this. But what shines in a period like this is not a strategy like bonds. So I want to be very clear. You need to make sure you are auditing your portfolio and you're looking to see if you have anything in your portfolio that is a bond asset class, because right now, unless you're buying individual bonds and you're holding them to maturity, you have a ton of interest rate risk in your portfolio. And we have no idea if this is a replay of the 70s again. I'm sure a lot of you listening right now will remember whenever the 70s, whenever the markets started to get hit by heavy inflation, there were literally lines outside now I wasn't around in the 70s, but I heard this from a lot of our clients. There were lines to the gas stations. Like you literally had to wait in line to be able to go and get gas because people were so worried. But the average annual inflation rate was well over 8% per year. And so do I think that's a repeat of 1970 to 1985? Not necessarily. But do you as the listener know, or do I know if it is? No. But the important thing is it happened before. And the best way for us to learn is to not repeat the mistakes of the past. And if we know that this has happened in the past, what we can do is stay away from strategies that would cause us to have failure in retirement. Bonds would, like if you have a very heavy bond exposure, let's say anything over 10%, I would be concerned with that right now. What would shine in a moment like this is starting to look at various other products that exist out there. I know that I have regularly talked about. There's a few different ones I want to highlight. You've got real estate as one asset class potentially, but that can be tough because there's two avenues that you're going to go. Either you're going to buy a piece of real estate and collect rent from that, which you could benefit from inflation because you can raise your prices over time, but you also have to deal with the tenants, the termites, and the toilets. You could also buy a real estate investment trust, so that's called a REIT. And if you purchase a REIT, I have seen so many clients come to us that have had a real estate investment trust in the past from another advisor, and they have not done well. So you really have to audit them. In my opinion, you're better off buying maybe a low-cost real estate index fund. So that's an option. You can look at insurance products. So you can look at things like guaranteed lifetime annuities. Those function a lot like a pension. That can be really good for someone who doesn't have a legacy goal.
If retirement clarity matters to you, don't wait. Text BOOK to 864-920-3155 or click the link in the description below to get a free copy of Jonathan's book, Retire Right.
So if you're listening to this right now and you're in your mid 50s to, mid 70s and you don't have children, a lifetime income annuity for you and your spouse can be very beneficial, as well as just a lifetime income annuity only on you. But that's for a very specific group of people who don't have a legacy goal. And then you can also look at various other insurance products like fixed index annuities that track the growth of an underlying market index, like the S&P 500. And the reason why I like those is it's kind of like bowling with bumpers. Those accounts make between 0% and 10% a year. So if the stock market or the S&P 500 goes up by 14, you make 10. If it goes down by 13 or 14, you can't lose anything and you lock in the gains. That's not every fixed index annuity. So make sure if you do get one of these, you get them through a qualified fiduciary advisor. But those are a couple of them. If your net worth is over $5 million a year, if your net worth is over 5 million, you can look at certain strategies like private equity. Those work really, 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 really well, where they'll produce income. And then the other one that you can look at is oil and gas investments directly right now. So you could be looking at this saying, hey, I actually want to run towards this and purchase more energy stocks. You could do anything from an energy ETF, something like an XLE. That's an example of an energy ETF. Not saying that's the one to buy. I have to be very careful. This is not a recommendation to buy or sell a security. I'm simply informing you. So make sure you talk to a qualified professional before making a financial decision. But XLE, or you could look at, you don't have to have 5 million to purchase XLE, but you could also look at a direct oil and gas investment. I know that's something that we like to use for clients to help them save on taxes as well. So those are a couple of the things that you can use and what you should be looking at. But in a time like this, it goes to show why having guarantees, why it's so valuable. And I actually sat with a client yesterday and we're running their review. So they've been with me for about 2.5 years. Great savers. They've saved over $4 million. And they were like, Jonathan, we have all these guaranteed strategies and we have some money in the market. But honestly, every time the market is booming, it's great. And I think to myself, like, oh, why don't we have more money in the market? Should we have more money in the market? But every time the market drops, like it has recently, I know how I would have acted in the past if this would have happened, and I would have been constantly checking my phone with our old advisor. I would have been in the weeds. My quality of life would have been very low. And you know what? We don't necessarily have a legacy goal to leave our kids. These folks didn't, but we don't necessarily have a legacy goal to leave our kids. So when we're 95, are we going to care that there's an extra $1 million in the account? No, not really. What I'm going to care is that I was more present, able to be involved in my community and my church in the time that I was here and healthy. And to me, that's way more valuable than an extra $1 million whenever I'm 95 and can't even use it. So I think at the end of the day, you have to create strategies based on your personal compass. Where is it that you want to go? What is it that you want to accomplish? And then you have to make sure that you're not acting emotionally. I have said this before in financial planning, and I'll say it again. High emotion equals low intelligence. Now, if you're listening to this right now, do not walk into your house this evening with your spouse and say that to your spouse whenever they start arguing with you. Don't say high emotion, low intelligence. That is a terrible decision to make, okay? But around the world of financial planning, high high emotion, low intelligence is really what I like to stick to. So make sure you have a diversified portfolio. Look into things like bonds right now, see what your exposure is there. Maybe you could turn that back. You know, again, I don't know you. I don't know your specific financial situation. We have a lot of clients who are listening to this right now. We also have a lot of non-clients who are listening to this right now. So it all depends on your financial situation. But look at those. What's your exposure to energy right now? Are you prepared for a stagflation event? So do you have guaranteed sources of income that you can rely on through a period like this? And then how are you able to weather the storm through a long recession if we were going into that? Do I think we are? No, not necessarily. I'm very optimistic about the future of the world. I think in general, technology has gotten to a point where we're faster and better than we ever have been before. And therefore, I think that leads to faster corrections if we do go through another market cycle. You got to think back in the 20s and 30s, they did not have FaceTime. Like people were communicating via carrier pigeon. Like if the market went down, like they sent out a newsletter and they're riding on horse and buggy to get the thing over there. And then those guys are having to react. They got to wait and then they got to send the letter back on horse and buggy. And everybody's like, so the world's faster. Like the economy is stronger than it's ever been, and you're going into retirement. And if you're going into retirement in a time like this, you got to think, wow, I'm so blessed. There's so much information. There's so much technology. There's so many good advisory firms that are out there. And look, whether you work with us or not, the thing that I want you to know is you've got to have confidence going into retirement. And if you don't feel that in your heart and in your gut, you need to reach out to someone and you need to say, hey, what can you guys do for me? I just want to have a conversation. Most firms don't even charge for a consultation. Like, talk to someone about your situation. It's important. I think it's important. I think it'll lead to you having a better quality of life in retirement, and that's what you deserve. So I appreciate you listening to the solo podcast. Don't let the war in Iran affect you. Go enjoy time with your kids and grandkids. Look, we live in the best country in the world, and we're in the we have defense technology that we don't even know about. And so, don't let any of the stuff that's going on overseas wreck your retirement. You should enjoy your retirement. And for me, keep listening, keep watching, have that white belt mentality, and we'll catch you on the next one.